Global markets are moving into another important phase today. Not a dramatic phase, not a loud phase, but a critical one. This is the type of moment most people ignore because nothing looks urgent on the surface. Prices move slowly, news feels repetitive, but behind the scenes, positioning is changing. Right now, money is not chasing returns. Money is protecting itself. Across global markets, liquidity is tightening quietly. Not through announcements, not through panic, but through behavior. Banks are lending less aggressively. Institutions are holding higher cash levels. Governments are choosing words carefully. This is not confidence. This is caution. In the United States, markets are slowly accepting a difficult reality. Interest rates may stay higher for longer than people expected. Inflation is cooling, yes, but it is not disappearing. Policymakers know that cutting too early could restart inflation pressures, and they also know that waiting too long could weaken growth, so they pause. And when policy pauses, markets hesitate. This hesitation is visible everywhere.
Stock markets are rotating, not rallying. Money moves from one sector to another instead of flooding the entire market. Growth stocks pause. Defensive stocks attract attention. Dividends matter again. This tells us something important. Investors are thinking about durability, not excitement. The bond market confirms this message. Yields are not collapsing, but they are no longer rising aggressively. This suggests that markets expect slower growth, not disaster. Bond investors are quietly preparing for a world where returns are harder to find and mistakes are more expensive. Gold reflects the same psychology. Gold is not exploding upward, but it refuses to break down. This is classic long-term hedging behavior. Investors are not betting on crisis. They're insuring against uncertainty. Silver remains more sensitive. Industrial demand. Banks, meanwhile, are adjusting their behavior faster than headlines suggest. They are tightening credit standards, reducing exposure to weaker borrowers, and increasing reserves. This is not fear. It is preparation. Banks remember what happens when optimism lasts too long. For businesses, this environment feels restrictive. Financing costs remain high. Expansion plans slow down. Hiring decisions become cautious. Small and medium businesses feel the pressure first. They rely on credit, and credit is becoming selective. Consumers respond naturally. They delay large purchases. They focus on essentials. They save where possible. This behavior does not create headlines, but it changes the economy from the inside. This is how slowdowns begin, not with crashes, but with restraint. So the question becomes simple. What breaks this balance? There are only a few forces strong enough. One is policy. If central banks clearly signal rate cuts, markets will respond quickly. Another is data. If growth weakens faster than expected, risk assets will reprice. And the third is shock, something unexpected. Geopolitical tension, financial stress, policy, error. Markets are not predicting which one comes first. They are preparing for all of them. That preparation is the story of today. This is not a market driven by greed. It is a market driven by memory. Investors remember inflation. They remember volatility. They remember how fast conditions can change. So they wait. They watch. They adjust quietly. This is why calm markets can be dangerous. Not because something bad must happen, but because attention fades. And when attention fades, moves become sharper. Smart money understands this. It does not chase noise. It does not react emotionally. It studies positioning, liquidity, and timing. Because the biggest financial shifts do not begin with headlines. They begin with silence. And right now, markets are very quiet.